In the first part of this two-part video series, we looked at excluding gain from the sale of a personal residence from taxation, and how gain on the sale of a personal residence is calculated. So having done all that, how is the sale of a personal residence reported on a tax return? This video attempts to answer that question. I'm the Tax Geek, and here's reporting the sale of a personal residence on your tax return, oversimplified. If you've landed here without watching the first video in the series, a card should pop up taking you to that video. If the card doesn't pop up, there will be a link to that video in this video's description. First of all sales of real estate are reported to the IRS, and thus to you on Form 1099-S. This form is not usually sent to you at the end of the year like other Forms 1099. Instead, the form, or a facsimile of the form, is included in the paperwork you received when you closed on the property. To report the sale on your tax return, you should first complete a Sale of Home Worksheet, which is shown on pages 15 and 16 of IRS Publication 523, Selling Your Home. This worksheet is for your records only and is not sent with the tax return. Then the sale is reported on Form 8949 and Schedule D with an adjustment showing any exclusion. If, after any exclusion, there is any taxable gain, the gain is reported, combined with any other capital gains and losses, on line 7 of Form 1040. Let's look at this example and see how this works. Gregory purchased his home for $153,500 in 2018, plus $2,350 in closing costs. He has lived in the home from the time he purchased it right up until he sold it in 2025. In the time he has owned it, he has installed new flooring at a cost of $4,700 and new landscaping for $5,500. He had solar panels installed in 2024, which cost $35,000, for which he claimed a clean energy credit of $10,500. In 2025, Gregory sold the home for $315,000 and received this Form 1099-S as part of his closing paperwork. His closing costs include an $18,900 real estate commission and $1,750 in additional closing costs. This is Gregory's Sale of Home Worksheet. Although the worksheet can be filled out by hand, it's usually completed by any software if you are self-preparing, or by your tax professional. Section 1 of the worksheet determines the selling price. On line 1A, he enters the $315,000 from the 1099-S. Since he received cash for the sale, no other lines apply to him, so he enters the same amount on line 1F. Selling expenses are entered in Section 2 of the worksheet. The real estate commission is entered on line 2A and the other closing costs on line 2E. These figures are totaled and entered on line 2F. The figure on line 2F is subtracted from the figure on line 1F to determine the amount realized. This figure, $294,350, is entered on line 3. Time to determine the basis. The original purchase price of the home is entered on line 4A, the closing cost paid at the time of purchase on line 4B, and the $45,250 he spent on the flooring, the landscaping, and the solar panels is entered on line 4D. None of the other lines apply to him, so the total of $201,050 shows up on line 4G. Section 5 totals basis adjustments. The clean energy credit he received must be subtracted from the home's basis. This lowers his adjusted basis to $190,550, which is entered on line 6. Subtracting line 6 from line 3 gives us a gain of $103,800. Since Gregory met both the ownership and use tests, the sale of the home qualifies for the full $250,000 exclusion of gain. Thus, none of his gain is taxable. The transaction is first reported on page 2 of Form 8949. Box F is checked because no 1099-B was received. Columns A, B, and C describe the property and give the date the property was originally purchased and subsequently sold. Now it gets a little complicated. Since Gregory received a 1099-S, the amount in Box 2 of the form is entered in column D, and the selling expenses from Section 2 of the worksheet is added to the adjusted basis entered in column E. Since the entire gain is excluded from taxable income, code H is entered in column F and the amount of the excluded gain in column G. When the figures are combined, there should be 0 in column H. Then the figures from columns D, E, G, and H are transferred to line 10 of Schedule D. Since there is no taxable gain, nothing is entered on Form 1040. Form 8949 and Schedule D are submitted with the tax return. And of course, this only applies to his personal residence as defined in the Part 1 video. If the house were not his personal residence, the gain is calculated the same, but could be entirely taxable as a capital gain. Rental properties that are sold are handled differently, and that process is described in my Selling Rental Properties video, linked above and in the video description, where you can also find links to additional resources and information. If you found this video informative, please give it a like and subscribe to see additional oversimplifications of our increasingly overcomplicated tax system. Your questions, comments, and suggestions are always welcome in the comment space below. Thanks for watching, and I'll be back soon with more of your taxes oversimplified.